Have you ever stopped to think about this little business puzzle? How can a seller get their money faster while at the same time a buyer actually pays less? It sounds kind of impossible, right? Well, today we're cracking the code on a simple but super powerful business tool that makes it happen. It's called the purchase discount, and we're going to see how it creates a huge win-win for everyone involved.
I mean, it really does sound like a paradox, doesn't it? Because usually in any kind of deal, one person's gain is another person's loss. But what if I told you there was a simple trick, a little mechanism that lets sellers get cash in their pockets sooner, while buyers get to lower their own costs, all in the same transaction? Well, there is, and it's one of the most fundamental tools in the entire world of commerce. You got to think about it from both sides of the table. For the seller, the second they make a sale, a clock starts ticking. They need that cash, right? They need it in the bank so they can pay their own suppliers, their employees, and keep the lights on. But for the buyer, the goal is pretty much the exact opposite. They want to lower their cost because every single dollar they can save on inventory is a dollar that goes straight to their bottom line, to their profit. At first glance, these two goals seem like they're in a total tug of war.
But this is where the absolute genius of the purchase discount comes into play. It's just such an elegant solution that's designed to bring those two competing goals into perfect alignment. And it's not a compromise either. It is a true, honest-to-goodness win-win.
So what is it exactly? Well, a purchase discount is basically an incentive. That's the key word here. The seller is essentially saying to the buyer, look, pay me early and I'll knock a little something off the price for you. It's a reward for being quick. And that word, incentive, is so important. It's a reward for a behavior that directly helps the seller's business.
Okay, so these incentives are communicated using a very specific kind of shorthand that you'll see on business invoices. Now, when you first look at it, it might seem like some kind of secret code, but I promise, once you learn to read the language, it's actually incredibly simple. And this right here, this is the classic. It's the most common format you are ever going to see. 210, net 30. It might just look like a jumble of numbers and letters, but every single part of that little phrase has a very specific, very important meaning that lays out the rules of the deal. So let's break it down, piece by piece.
Okay, here we go. First up, that 2 at the beginning, that's your discount. 2% off the total invoice. Simple enough. The 10 is your window of opportunity. The buyer has just 10 days from the date on the invoice to pay up and claim that 2% discount. And finally, net 30. That's the absolute final deadline. Discount or no discount, the full net amount is due within 30 days. So you get a deal if you're fast, but you have to pay the full price by day 30, period.
All right, let's look at some real numbers because that makes it so much clearer. Let's say you have a $1,000 invoice with our 2/10 net 30 terms. If you pay within those first 10 days, you get to take 2% off. That's a $20 savings. You only have to pay $980. But if you wait until day 11, poof, that opportunity is gone and now you owe the full $1,000 by day 30. This creates a really clear strategic choice for the buyer, right? Is that $20 in savings more valuable than holding onto your cash for an extra 20 days? So, okay, saving $20 is nice. We all like saving money. But what does it actually do for the business's finances? I mean, what's the real impact here? To see the true power of these little discounts, we have to look at how they get recorded in the accounting books. It's not just found money. It has a very specific and very important role. And here it is. This is the crucial accounting detail. That $20 savings isn't just booked as extra income or profit, no. Instead, it is recorded as a direct reduction in the cost of the inventory you just bought. And that lowers a really key metric on your financial statements called the cost of goods sold, or CGS. And this chart, it illustrates the impact perfectly. That inventory you bought for $1,000 is now officially on your books as costing you only $980. So why does that matter so much? Because when you lower your cost of goods sold, you directly increase your gross profit margin every single time you sell one of those items. It's a small change on one invoice, sure, but when you do that over and over and over again, it can have a huge impact on a company's bottom line.
Now, I know this might seem like a small, technical detail in the grand scheme of running a business, but honestly, mastering the strategic use of purchase discounts is a true hallmark of a financially sharp operation. It's about so much more than just saving a few bucks here and there. So, let's just recap this perfect win-win situation. For the buyer, it's a no-brainer. Lower costs, which means higher profits.
For the seller, it's an incredibly powerful tool to get that cash in the door faster and cut down on the headache of chasing down late payments. And maybe most importantly, for both of them, it helps build a stronger, more reliable business relationship that's founded on trust and mutual benefit.
And that really leaves us with the big strategic question that's at the heart of all this. As a buyer, you have to make a choice. Is it better to grab that immediate 2% savings? Or is it more valuable for your specific business to hold on to your cash for those extra 20 days? There's no single right answer here. It all depends on your company's financial situation and your strategic goals. And thinking through that very choice, well, that's what smart financial management is all about.